at $6.78, down $0.11 or 1.60%. And right there is the core of the issue with this particular stock, a seemingly minor daily fluctuation that belies a much larger, more contentious story playing out on Wall Street. The common belief, the one you'll hear repeated in forums and see plastered across social media, is that SoFi is the financial institution of the future, a one-stop shop designed for a new generation. The expectation is a sleek, technology-driven platform poised to disrupt the old guard's banking. But the reality, the one dictated by institutional capital and reflected in that daily price action, is that SoFi is being judged not on its potential as a tech disruptor, but on the harsh, unforgiving metrics of a conventional bank. The market isn't looking at the user interface, it's looking at credit quality, funding costs, and net interest margins. And that disconnect between the grand vision and the current financial reality is where both the immense opportunity and the significant risk in SoFi stock truly lie. Many investors, especially those using platforms like the Robinhood app or the SoFi Invest platform itself, were drawn to SoFi for its growth narrative. They see a company that understands its demographic, offering everything from student loan refinancing and personal loans to SoFi stocks and ETF investing, all within a single cohesive ecosystem. The story is compelling. Build a relationship with a young professional by refinancing their student debt, then become their trusted partner for life, handling their mortgage, their online investing, their credit card, and eventually their wealth management. It's a powerful idea, and Anthony Noto is an exceptionally good storyteller when it comes to articulating this vision. The market bought into it, sending the stock to incredible highs in the past, but the mood has shifted. Big money, the kind that moves through Fidelity Wealth Management or is managed by algorithms in a Schwab Intelligent Portfolios account, is now applying a different, more skeptical lens. They aren't asking if the app is good. They're asking if the loans underwritten in 2021 and 2022 will perform in a prolonged high interest rate environment. They're scrutinizing the company's cost of capital and whether it can attract and retain deposits cheaply enough to compete with giants like J.P. Morgan Chase and Bank of America. This intense scrutiny is why the stock has been so volatile. Look at the trading patterns over the last several months. SoFi doesn't trade like a tech company such as Apple stock or Nvidia stock anymore. It trades in lockstep with macroeconomic data releases. When a CPI report comes in hotter than expected, suggesting the Federal Reserve might keep rates higher for longer, SoFi stock sells off sharply. Why? Because higher rates put pressure on its borrowers, increasing the risk of defaults in its personal loan portfolio. Higher rates also increase its own funding costs, squeezing those all-important net interest margins. Conversely, on any hint of a dovish pivot from the Fed, the stock can experience significant short-covering rallies. This isn't the behavior of a company being valued on its user growth or its technology stack. It's the behavior of a company whose fate is directly tied to the cost of credit. The daily trading volume often tells a revealing story. We frequently see volume spikes not on company-specific news, but on days with major economic reports. This indicates that a large portion of the trading is macro-driven, with traders and algorithms using SoFi as a proxy for their bets on the direction of the economy and interest rates. It's a far cry from the narrative of a stable, long-term tech holding. Let's dissect the company structure to understand these pressures more clearly. SoFi operates through three distinct segments. First, and most importantly for its bottom line right now, is lending. This includes student loans, personal loans, and home loans. This is their legacy business and their primary revenue driver. The expectation was that this segment would be a stable cash cow that would fund the growth of the other businesses. The reality is that it's a deeply cyclical business, highly sensitive to credit conditions. The end of the student loan moratorium was supposed to be a massive tailwind, and while it did drive volume, it also brought questions about the creditworthiness of borrowers now facing renewed payment obligations. Second is the technology platform, primarily Galileo, which provides the back-end infrastructure for many other fintechs. This was meant to be the high-margin software-as-a-service component that would justify a tech valuation. The reality is that Galileo's growth has slowed as its own clients, other fintechs, face a tougher funding environment. The third segment is financial services, which includes SoFi Money, their checking and savings product, SoFi Invest, the credit card, and other products. This is the heart of the super app strategy, designed to increase customer lifetime value through cross-selling. The expectation is that this segment will become the primary point of interaction and profitability. The reality is that it's an incredibly competitive space, and while SoFi has seen impressive growth in deposits since obtaining its bank charter, this segment is still largely a cost center, burning cash to acquire customers in the hope of future profitability. The recent earnings reports have been a perfect illustration of this tension. Management highlights the record member growth and the impressive deposit inflows into SoFi Money, painting a picture of a flourishing digital ecosystem. They talk about the financial services productivity loop, where one product seamlessly leads a customer to the next. The market listens, and the stock might even pop in the pre-market. But then, during the earnings call, the analysts from major banks start asking the tough questions. They press on the delinquency rates in the personal loan portfolio. They dig into the weighted average life of the loans and the assumptions used in their models. They question the guidance on net interest margin. And as this happens, you can often see the stock give back its gains and sometimes turn negative. This is the expectation of a tech growth story colliding head-on with the reality of banking fundamentals. What institutional investors, those managing funds for Fidelity investments or advising clients through interactive brokers, are trying to figure out is simple. Is SoFi a technology company that happens to have a bank charter, or is it a bank that happens to have a good mobile app? The answer to that question determines whether the stock should trade at a price-to-earnings multiple of 30 or a price-to-tangible book value of 1.5. Looking forward, the path for SoFi is fraught with both significant catalysts and substantial risks. The bull case, the one that could see the stock double or triple from current levels, rests on flawless execution. In this scenario, the company successfully navigates the current credit cycle. Their underwriting models prove to be robust and default rates remain manageable. The bank charter becomes a massive competitive advantage, allowing them to lower their cost of funds significantly as they gather more high-quality deposits. The financial services segment starts to generate meaningful, high-margin revenue as they successfully cross-sell products like investment accounts and financial planning services to their large user base. If they can achieve sustained GAAP profitability and prove that their integrated model is fundamentally more efficient than traditional banking, Wall Street will be forced to reevaluate the narrative and assign it a much higher valuation. This is the future that long-term believers are holding out for, and it's not an impossible scenario. However, the bear case is equally plausible and cannot be ignored. A deeper than expected recession could be devastating for SoFi's loan book, which is heavily concentrated in unsecured personal loans. Even a modest uptick in unemployment could lead to a sharp rise in delinquencies and charge-offs, wiping out their profitability. Competition is another major risk. While SoFi has a strong brand, it's fighting a war on multiple fronts. In lending, it competes with traditional banks. In investing, it competes with established players like Fidelity Brokerage and disruptive ones like Robinhood. In the fintech infrastructure space, Galileo faces numerous competitors. There is a real risk that SoFi becomes a jack of all trades but a master of none, failing to achieve the necessary scale in any one area to become truly dominant. Furthermore, the company is still heavily reliant on CEO Anthony Noto. His leadership has been critical, but this key person risk is something institutional investors take seriously. If he were to depart, it would create a massive vacuum of leadership and strategic direction, which would almost certainly be punished by the market. Tell me what you think. Comment below if you believe SoFi can become a top 10 U.S. financial institution in the next decade. Ultimately, investing in SoFi today is a bet on whether the long-term vision can overcome the short-term macroeconomic reality. The expectation is a seamless, all-in-one financial super app that will redefine consumer banking. The reality is a young, tech-forward bank navigating a treacherous economic landscape where credit quality and interest margins are the only things that truly matter for the time being. The company has the assets, a strong brand, a large and growing member base, a national bank charter, and a talented CEO. But it also has the liabilities of a lender exposed to an